One of the biggest surprises for most first-time homebuyers I talk to is how much closing costs run. These are the extra fees that you pay when you close on a home over and above your down payment, and they really add up. If you're making a low down payment, they could equal or even exceed the amount that you're putting down. So in this video, I'm going to make sure you're not surprised by all the closing costs. But before we jump into all the details, I want to mention that most loan programs allow the seller to pay for some or all of the closing costs, and loan rules vary, but in some instances, if you can negotiate a big enough credit, you might be able to get the seller to chip in for 100% of your closing costs. Whether you pay them or not, it's still important to understand what they are, and you came to the right place. I'll run through all the costs with a range for what you can expect to pay for each, and stick around to the end and I'll summarize all the details in a few examples so you can see everything in one place. And if along the way you find this video informative, please like and subscribe. And remember, I'm here if you're in the market for a mortgage. I'd be thrilled to connect and help out. So let's dive in and break it all down. There are two main categories of costs you'll pay at closing: true closing costs and prepaids. So we're going to talk about closing costs first. Closing costs are the one-time transaction expenses that you'll pay in connection with buying and financing a home. These are fees that are one and done and won't recur until you buy a home again or refinance your home. A lot of these costs fall into categories of things that you would pay to third parties. And it's interesting to note that a lot of those third-party fees are things you'd pay even if you were paying cash. But I'm going to start by talking about the lender and loan-related costs. And of course, lender and loan-related costs are going to include the fees that you pay directly to your lender. These are fees that offset administrative costs your lender incurs as they set up your loan. They go by a lot of names: administrative, application, underwriting, document preparation, processing. There are probably some other creative names out there, but they'll all have that kind of feel to them. These fees commonly add up to around $1,000 to $2,000. The company I work for keeps it simple. We charge a lender fee. It's $1,440. And of course, another lender fee is your credit report. Expect to pay $30 to $100 per borrower. If your new home is in a flood zone, you'll be required to purchase flood insurance, and your lender is going to figure out if the property is in a flood zone by hiring a third party to research FEMA's maps and provide a flood certification or flood cert. The cost of this certification is usually around $15 to $20. My company pays this fee for you. Other companies might pass it through. Your lender will also hire a third-party service to verify your property taxes get paid on time through the life of your loan. And this is important to you and your lender, as the county can foreclose if your taxes aren't paid. This fee usually costs around $50 to $100, and every year behind the scenes for this small fee, this third-party company will check and make sure the property taxes got paid on time. My company passes through a $68 charge from our vendor for this service. And of course, there's going to be an appraisal. Maybe. An appraisal is a professional opinion of the value of your home. Your lender will order the appraisal after you get an offer accepted, and the fees for these vary a ton by state and area and property type and a whole bunch of variables. In lower cost states, the fees are going to start around maybe $450. In higher cost states, you can expect to pay $800 or even more. And if you're buying a rental or a multifamily property, or 2, 3, or 4 unit property, or a home in a rural area, or a property that has a unique feature, maybe it's a manufactured home, maybe it has an accessory dwelling unit, you can expect to pay a premium. Those are more work for the appraisers or more distance for the appraisers to travel to do their thing, so they'll charge more for that. These days, not every transaction, however, requires an appraisal. If you're putting 20% down or more on a conventional loan, your appraisal may be waived, or what lenders are starting to call, you may receive value acceptance, which means an appraisal isn't necessary for mortgage purposes. Now, if you're putting less than 20% down, you'll most likely be required to purchase mortgage insurance. If you put 20% or more down, you're really insulating your lender from potential losses in the case of a foreclosure. You've got enough down payment in that the mortgage debt is sufficient that it should be covered after a foreclosure when the lender resells the property. Mortgage insurance kicks in if you put less than 20% down to cover losses that lenders would incur when a loan goes to foreclosure with a smaller down payment. MI is most commonly included as a part of your monthly payment, but some loan programs offer the option to pay MI partially or entirely in a lump sum at closing. These single mortgage insurance options let you kind of rip off the Band-Aid and eliminate mortgage insurance from your monthly payment. Single MI premiums range from 0.3% of your loan amount, give or take, to sometimes over 2% of the loan amount. And in some instances, you can roll the cost of a single mortgage insurance premium into your loan to reduce what you have to pay in cash at closing. You want to do an analysis of whether a single or a monthly mortgage insurance premium is a better option, and this is really going to depend on how quickly you think the home value is going to go up, how long you think you're going to have the loan, how quickly you think you're going to be paying the loan balance down. And then the last loan-related cost I want to talk about is discount points and discount points cousin lender credits. Points or lender credits are always a percent of your loan. If you're borrowing, say, $400,000, one discount point would equal 1% of your loan amount. That would be $4,000. Points and lender credits are really two sides of a coin. When you pay them as a fee at closing, they're called discount points. And if your lender pays them to you, which is a thing, they're called a lender credit. But they're truly the same thing. A deep dive into points can go really deep into a conversation about how lenders sell loans on the secondary mortgage market. But to keep it really simple, and truly it's accurate to think of it this way, you can just think of points as prepaid interest. If you pay extra interest up front at closing, you can buy yourself a lower interest rate over the life of the loan. So picture a seesaw. The more you pay in discount points, the lower your interest rate will be, and vice versa. As you go up in rate and down in cost, you can even get to a point where instead of paying points, your lender will pay a credit to you that you can use to cover or kind of offset some of those other closing costs. You'll settle on the amount of points that you pay, kind of make that decision as you lock in your interest rate. And when you're making a decision about points, you should aim to strike a balance. A lot of things in life, I suppose, but definitely lending, are really all about finding a balance. In this case, it's going to be the balance between what you pay at closing and the interest you pay over time. The longer you think you'll be paying on your loan, the more benefit you'll get out of having a lower rate, more savings over time, which makes points more appealing. And I've created a spreadsheet that I like using with my clients to analyze this decision. If we work together, you'll get a really transparent view of what you're paying at closing, how that affects your interest costs over time, when you're going to break even on any upfront costs. And this information really can make the decisions around this topic, which can kind of feel a little confusing at first sometimes, much simpler than you would think. So next I want to talk about loan guarantee fees. If you're getting an FHA, USDA, or VA loan, a government agency is going to guarantee or insure your loan, and you'll pay a fee in connection with this guarantee. These fees are paid to the government to fund the program that you're participating in, and they're almost always financed into your mortgage, so they're not going to be money out of pocket at closing. FHA charges an upfront mortgage insurance premium equal to 1.75% of your loan amount. USDA charges a guarantee fee of 1%, and VA loans require a funding fee. That can be as little as 1.25% of the loan amount or as much as 3.3% of the loan amount, depending on how much you're putting down. And you don't have to make a down payment, but if you put more down, the funding fee is reduced, and whether or not you've used your VA loan eligibility previously. But if you have any service-connected disability, if you have a service-connected disability rating, the funding fee is waived. And it's worth noting, if you get a service-connected disability rating from the VA after paying a funding fee, you could be eligible for a refund. Now, Let's move on to talking about some of the other expenses. These aren't specifically loan related, and in fact, you'll pay most, if not all of these, even if you are paying cash for your property. The first of these is settlement fees. To facilitate closing your home purchase, you'll need a neutral agent to handle all the money and documentation. In some states, this is going to be an attorney. This is most common east of the Mississippi. In others, it will be an escrow agent with the title company, and this is most typical in the West. In general, these fees are split between the buyer and the seller because you're both benefiting from using a neutral agent to settle the transaction. Although there are states, particularly states where you use attorneys, where you and your seller will hire your own attorney to represent you through the transaction. These fees vary by state and loan amount. $300 to $1,500 is probably a range that covers most situations. I know that's a big range, but it can vary a lot. And if you can't make it to the title company, I guess I should mention, if you can't go to the title company or the attorney's office to sign your closing papers, a notary service can facilitate the signing for you. And it used to be that these were always mobile notary services, literally a person who shows up with their notary stamp and all the papers that you need to sign. And mobile notaries are still an option, but increasingly, many closings are performed online with remote online notaries, or a RON. You can expect to pay, whether it's a mobile notary or an online service, $100 to $300, plus some, if you're using a in-person mobile notary, maybe some overnight delivery fees if you're signing out of the immediate area of your closing. And of course, the title company will also provide title insurance. They'll issue 2 insurance policies at closing. One's called an owner's policy and the other is called a lender's policy. Owner's title insurance covers your right to own the property. The title company will research and verify that the seller has clear title to the property and can legally convey it to you at closing without any challenges to their right to own the property. That's called clear title, or title with no clouds on it. And in some states, the title company, as a part of the title search, will require a survey. These vary from $300 to $600 or $700. The lender's policy, the other policy, protects against liens. It has to do with money. And lien is just lender speak for debt. The title company is going to research all the debts or liens attached to the property and list them on a preliminary title report. These could include things like, the obvious things would be mortgages, property taxes, but maybe the seller's behind on child support, or they have a debt to the IRS that became a lien. Lots of other stuff can show up. The municipality could have liened the property for an improvement, street improvements, or maybe installing sewers. So all of these debts will be listed on the report, and then they're going to get paid off at or before closing. And this is important to you because you don't want to inherit any of your seller's debts, even if it was something like their child support. If it's still a lien on that property and the house is yours, then that debt is yours too. And it's important to your lender as well, because we want to be in first lien position. We want to be the only debt secured to your new home. That protects us. Claims on title policies are super rare, but it's really good to have this insurance. It's required to have this insurance, and it's always better to be safe than sorry. Title insurance costs are another thing that can vary a lot by state, and also with the size of the loan. The bigger the loan, the bigger the risk for the title policy. So if I had to come up with a number, I'd say $400 to $4,000 is probably not a bad ballpark, but that's a broad range, so it's probably best to get a specific quote, specific information for your loan. And again, I'm going to show you some examples toward the end here. And who pays each policy is dictated by local custom and can be negotiated between the buyer and the seller. In some instances, the seller is going to automatically pay for at least some of the title insurance costs, but if you want them to pay more, then that would be part of your negotiations. And at closing, of course, you're going to sign a bunch of papers, and a few of them, most notably 2 deeds, will be recorded with the county. And recording the deeds, if you really want to just boil it down, is kind of the point of this whole exercise, because recording a deed is what conveys ownership of the property from the seller to you. When the deed is recorded, the house is yours. The settlement agent is going to handle the recording, but they're going to pass through the recording fees charged by the county. And these usually run between $100, $150 to maybe as much as $500. And then if your seller has any debts secured to the home, the title company is going to make sure that they're paid off at closing. That's part of that title insurance that I just talked about. And once the debts are paid, especially if it's a mortgage, the seller's lender is going to release their lien on the house by recording something called a reconveyance. The seller is generally going to pick up the tab for this cost. It'd be $100 to $200 per lien. It's not super expensive. You'll pay these if you ever refinance your property in the future, but you probably won't pay them on a purchase. And then transfer taxes, stamp taxes, mortgage taxes. Many states charge transfer taxes whenever the ownership of a home changes, or a mortgage tax, not as common, but sometimes a tax for a mortgage when a new mortgage loan is recorded. And a few cities and counties get in on the tax game too. These taxes can vary a lot, as does who pays for them, whether it's you or the seller. They're notably higher in some states. New York and Florida kind of pop to mind. In my home state of Oregon, only one county charges a really small transfer tax. It's only $1 per thousand of the sales price, which gets split between the buyer and the seller. If you're buying a $500,000 home, it'd be $500, and you and the seller would each pay $250. But in Washington state, just across the border to the north, they charge an excise tax to the seller, usually, which ranges from 1.1 to 3% of the sales price, and then there are usually additional city taxes on top of that. So that's a huge expense and just gives you an idea of how varied these costs can be. And that's it for closing costs. But in addition to all these one-time expenses, you'll also have an initial installment of some of your recurring costs due at closing. And these are called prepaids. When we talk about closing costs generically, closing costs and prepaids sometimes get lumped together, but prepaids really are different. They're a prepayment of future expenses. You have stuff you're going to continue paying on an ongoing basis over the years that you own your home, and the prepaids are the beginning, or you can think of them as an initial installment of these costs. So let's dive into the details for these. The first is interest. You pay interest at closing from the day you close to the end of the month in which you close. The per day interest cost is figured by multiplying your interest rate times your loan amount and dividing by 365. And this can vary from as little as 1 day of interest to as much as a month of interest. It's worth noting, before you get excited about closing at the end of the month and paying less interest at closing, that if you pay more interest at closing, it kind of just kicks the can a little when it comes to your first loan payment. The more interest you pay at closing, the further away you are from writing your first mortgage check. And then, of course, you're going to pay for some insurance on your home. You'll pay your first year of homeowner's insurance at closing. Once your offer is accepted, you should get to work picking out an insurance agent, calling around, getting any quotes that you want to get for homeowner's insurance. You'll tell your lender who you want to use for insurance, and you'll talk to your insurance agent directly about what that insurance premium is going to be, but you don't have to pay it. At closing, the settlement agent will collect the premium and send it off to your insurance agent for you, and that'll pay for the first year. Once you purchase your home, you'll be on the hook, of course, for property taxes, but your purchase date is really unlikely to perfectly sync up with the due date for property taxes. So your purchase agreement is going to include a clause that spells out how you and your seller are going to square up for the current year of property taxes. And this is typically just a per day prorate. So you'll pay taxes for the day you own the property, they'll pay taxes for the days they own the property, and the closing agent is going to help with this. They'll calculate the costs right down to the day and make sure that you and the seller and the county or other taxing authorities are all squared up. Depending on the fiscal year for which taxes are paid and the closing date, these prorates could be something that you pay, or they could be something that you actually receive as a credit. And then most mortgages are set up with an escrow for taxes and insurance. And this means for taxes and insurance, you'll pay them in with your mortgage payment. This is really convenient. It means you don't have to save up separately or keep tabs on how much the costs are or when they come due, although you should probably pay attention to what your insurance premium is over the year. But your lender will really do all the work. They'll collect a 12th of your taxes and a 12th of your insurance every month in with your mortgage payment. And as they collect these funds, they're not due yet. They have to park them somewhere. So they put them into a savings account. You can think of this as a little savings account that's like a sidecar to your mortgage. And then every year when taxes and insurance come due, taxes sometimes are different intervals, but whenever they come due, your lender's going to pay them for you out of this savings account. At closing, your lender is going to work out an initial deposit that you're going to kick into that account so that it syncs up with the due dates for taxes and the anticipated renewal date for your insurance. You can kind of think of those prorates for taxes and the initial year of insurance that you pay at closing as being for this year. And then the escrow, it feels a little funny to be paying it, almost redundant, but the escrow is really starting to set aside money for next year. Because if you didn't set aside any money for next year, if you paid no taxes and insurance in your payment because you paid some at closing, then those accounts would be empty when the time came to pay the taxes and insurance the next time. And then I also want to mention there's some closing costs that could kick in based on the type of property or your loan program or other things, kind of on a case-by-case basis. So I want to start with condos. If you're purchasing a condominium, your lender will need to make sure that the homeowners association meets loan requirements. Most HOAs are run by property management companies that are a fee-for-service entity. They charge a fee for everything they do, including gathering and sharing the information that lenders need to underwrite the HOA. $200 to $500 is pretty typical for this. Now, there are self-managed HOAs where maybe there won't be a fee because one of your new neighbors is going to do that work for you. The management company also may charge a transfer or a setup fee at closing as they onboard you as a new homeowner and set you up in their system and set you up for payments of HOA dues and so on. That's often a couple $100s, something along that line. And then most HOAs are also going to require that you pay your first month of HOA dues at closing. And then it's really common for the HOA to require that you kick some funds into the building maintenance fund. And this is oftentimes an amount equivalent to 2 months of your dues, but it's not dues, it's going into the fund that keeps the building up and maintains the property, what's often called the reserve account. And then rural homes or manufactured homes, not always the same thing, but I'll kind of lump them in together. They can come with some extra fees. I guess they often do go together, but not always. If you buy a manufactured home, whether it's rural or not, certain loans are going to require that you hire an engineer to inspect the property, inspect the foundation to make sure that it was installed properly, that it meets all the requirements for the loan or local code, maybe inspect the property itself, especially if it's been modified from how it was originally installed, if there's been an addition or a bump out or something was done. $500 is pretty common for these engineering fees, but it can vary depending on area and I guess the engineer you hire. And if any of the manufacturing tags or labels are missing, and these are crazy to think about it, little pieces of paper that get taped in various places of a manufactured home, sometimes in a kitchen cabinet or by a water heater or electrical panel. If somebody remodeled and these went missing, then you have to have reprints of them. They have information that's critical for your lender. You can order them online. If you get going early, it's $75. If you need to order it on a rush, it can be as much as $250. And if the home you buy isn't connected to public utilities, your lender may require a septic inspection or a flow test for your well or a well water quality test. And these are things that are generally going to be $1 to $2 to $3 to $4 to maybe $500 a piece, something in that neighborhood. Some loan programs require homebuyer education. This is most common if you're a first-time homebuyer, and these courses, whether you're a first-time buyer or not, can be a great way to set yourself up for success as a homeowner. They may come with a discount on your closing costs, your mortgage insurance, or both, and if they're required by your lender, you're probably getting one of these discounts. The classes can usually be completed either in person or online. Most of the time they're free, but occasionally there can be a small fee, $100 or $200. And for the most part, home inspections are not something that you're required to do. They're for you, not your lender. They're for you to learn about the home and decide if you want to buy it, negotiate repairs or credits with the seller. They're also a really great way to get to know your home's future maintenance needs, what you're going to need to do to keep the home up and in good shape and manage your investment over the years. But in rare cases, some loan programs will require that you provide a copy of the report or a portion of the report to your lender. Sometimes it would be what's called a pest and dry rot report, just showing the home is free of pests, bugs and rodents and so on, and any dry rot, any rotten wood. If the appraisal or sales agreement calls out any areas of concern, however, an underwriter could request a copy of the home inspection or maybe a report from a specialist like a roofer or an engineer or a contractor. It's not typical, and in general, I would recommend not sending your home inspection to your lender. The appraiser is going to be your lender's eyes and ears at the property, and they'll let you know if they need anything further. And also, although it sounds kind of funny to talk about rent in connection with a home purchase, you might wind up paying or receiving rent at closing. When you write your offer, you and your seller are going to negotiate two dates: the closing date and the date of possession. These dates are often the same, but not always. Your seller might want to keep possession of the property after closing. This can give them time to find a new home to buy, or maybe just give them some time to pack and move, do work to a new home before they move. Or maybe, and this is less common, you could negotiate what's called early occupancy. That would give you the opportunity to potentially move into the property before your closing date. So you'll briefly be a renter in your new home before you close on it and own it. Or maybe you're buying a property that has a renter living in it. If it's investment property and you're going to leave the renter in it, or the renter hasn't moved out yet so that you can move in. In all these cases, your contract and your closing statement could include some rent paid by you or paid to you at closing. And as promised, I want to bring it all home with some examples. So let's look at how 3 different loan types compare. And for this first comparison, I'm going to use numbers that are based on my home base of Oregon. We'll look at an FHA loan with 3.5% down on a $500,000 purchase price. We'll look at a conforming loan with 5% down on a $500,000 purchase price, and a jumbo loan with 20% down on a $1 million purchase price. So first, let's look at the closing costs, and we'll get started talking about the lender and loan related costs. Lender fees, as I mentioned earlier, are for my company $1,440, and we pass through a $68 tax service fee. Again, for the life of the loan, the tax service company is going to keep tabs on the property taxes, make sure they're paid on time each year, and make sure the property doesn't go to a tax foreclosure. Appraisals in Oregon are at the higher end of the spectrum, as you'll see when we compare some other states later. $800 or thereabouts is what you can expect in Oregon, and we pass through our $40 credit report fee. And then we move on to, because this is an FHA loan, loan guarantee fees. FHA has an upfront mortgage insurance premium equal to 1.75% of the loan amount. That would be $8,444. Now, we are going to finance this with this FHA loan. That's traditional, but it is a healthy number. And we move on then to the title, escrow, and attorney's fees. And these expenses are going to include the settlement fee, which is the fee that you pay the settlement agent, and in Oregon that's going to be a title company, the escrow division of a title company, for handling all the paper and money and making sure that the transaction is settled in an orderly way and serve both you and the seller, and that settlement fee would be $1,000. Lender's title insurance, which is the insurance that insures against liens or debts secured to the property, would be $500. And there's some endorsements in Oregon, or riders, that get added to that title policy for another $100. There's a small electronic recording fee that the county charges to the title company, and they're going to pass that through to you. And then recording fees are generally between $350 and $400 in Oregon. That's for recording the deeds, both to convey ownership of the property from the seller to you and to file the lien against the property so the mortgage is secured to the property in public record. And next we're going to talk about or sum up the closing costs, the sum total of all the closing costs is $12,827. But remember that upfront mortgage insurance premium is going to be financed. So when we take away that $8,443 that's being financed, the net closing cost that you need to pay in cash will be about $4,400. But that's not everything, because we have those prepaids. And the prepaids are going to be the first installment of the interest and taxes and insurance. Now, for the interest, I'm going to include 30 days of interest, $2,500 here. This could be as little as a day or as much as 30 days. You pay interest from the day you close until the end of the month in which you close at closing. I always like estimating to the high side so that that number will be smaller down the road. And remember, as I said before, you're really kicking the can to later first mortgage payment date if you pay more interest at closing. In this example, if you paid 30 days of interest at closing, you wouldn't actually have a mortgage payment due for 60 days. First year of homeowners insurance is going to be due at closing, and Oregon is one of the lower cost homeowners insurance states. $900 probably isn't a bad guess, but this is something you're going to get a quote for from your own homeowner's insurance agent, and the premium will be whatever you and your agent settle on. And then property taxes are going to show up in two places. There are prorates, and Oregon has a strange fiscal year for taxes, July 1st to June 30th, and taxes are paid about midway through the year. I figured the taxes for this example as though we were closing about now, which is late. I'm recording this in late April. So the buyer would owe the seller a little bit of a credit to pay them back for some of the taxes that they paid for the current fiscal year in Oregon. And you'll see this changes when we look at other states. And then we're going to set up that reserve account that we talked about. We need to make an initial deposit for taxes and an initial deposit for insurance to sync those up with the tax year. For these numbers, I'm assuming $4,800 a year for property taxes. Property taxes can vary a lot in Oregon, but that's not a bad placeholder for this price range. So if we tally up all of those prepaids, we're looking at $8,400 of prepaids, and then the grand total for all the closing costs and prepaids that aren't financed, remember that upfront mortgage insurance premium is financed, will be just shy of $13,000. If we move on to the conforming loan, a lot of similarities because we're assuming the same purchase price and roughly the same loan amount, just a little more down payment. So all of those loan and lender related costs are going to be identical. They don't change based on the loan amount or sales price. And because this is a conforming loan, there's no upfront mortgage insurance premium. The title and escrow and settlement fee will be exactly the same. That's based on the sales price. The lender's title insurance will be ever so slightly cheaper because it is a slightly smaller loan amount with 5 instead of 3.5% down. And the rest of those settlement fees aren't related to the loan amount or closing costs. So the endorsements and recording fees are going to be identical. So total of the closing costs, super similar, almost the same as what you would pay on the FHA loan. And the prepaids are going to be the same story. The loan's just ever so slightly smaller, so 30 days of interest will be ever so slightly less. And the taxes and the insurance and the escrows are going to be completely identical. So the grand total will be very, very similar, just slightly less than $13,000. So what happens if we jump up to $1 million purchase price with 20% down? So twice the purchase price, hundreds of thousands, 300,000 more in loan amount, just about. Well, all those lender and loan related costs don't change. They're the same and they are not affected by the loan amount or the sales price. And this isn't a government insured loan, so there's no guarantee fee. And the title and escrow fees are going to be just a little more, bigger sales price, so bigger settlement fee, and slightly higher lender's title insurance because the loan amount is several $100,000 larger, but not a whole lot of difference as you can see. And then the rest of those title and escrow fees are going to be identical. The total of the closing costs, even though the loan is $300,000 more and the purchase price is twice as much, just a few $100s more, really, really similar closing costs. That is not going to be the story with the prepaids, however. The interest on a much larger loan amount is, of course, more, so you're going to have more in interim interest, and a more expensive property will have more expensive homeowners insurance as well. My placeholder for this, again, a pretty reasonable number based on my experience, would be $1,800. And the property tax prorates are also going to likely be more. I've assumed $9,000 a year for property taxes on this $1 million property. So as you pay the prorates to the seller and set up that escrow account, those are going to be bigger numbers as well. So the grand total in this example would be about $15,500, and the total for all the closing costs and prepaids will be $20,000, just over $20,000. Now, how does this compare if we look at different states? Well, let's take a look and see. We're going to compare Oregon, Colorado, Florida, and Texas, and we're going to use a $500,000 purchase price on a conventional loan with 5% down across the board in all examples. And we know what Oregon looks like. We just ran through those numbers together. So let's compare Colorado. So the lender fees are going to be basically identical with one exception. The appraisal fees will be less costly in Colorado. As I mentioned before, Oregon's toward the higher end of the spectrum for appraisal expenses. The settlement fees with the title company are also going to be a little bit lower. Settlement charges are less. The lender's title insurance is less, and there is no owner's title insurance listed here for Oregon or Colorado because by tradition in both Oregon and Colorado, the seller pays that owner's title insurance. And then no endorsements, and recording fees are pretty inexpensive in Colorado, a little less costly. Now you will in this, unlike in Oregon, where there are no taxes, no government taxes associated with recording the transaction unless you're in Washington County, as I mentioned before, that one county, but there are some small taxes that accrue in Colorado. So total closing costs with all of those little differences one way or the other ring in to be less expensive in Colorado. So let's look at the closing costs in Florida. Lender fees are going to be identical, and again, the appraisal is going to be a little less expensive than in either Oregon or Colorado. Settlement fees are more, and you'll notice that the title insurance is more expensive, and the buyer is actually paying both parts of the title insurance. So those expenses both accrue. There are some endorsements, and then in Florida, typically the title company will want to perform a survey to check the boundaries and location of the property, make sure that there are no encroachments or that the property isn't encroaching on other properties. And all that means is the property is on its own, within its boundaries. All the structures on the property are within its correct legal boundaries. And then recording fees are going to be in that same ballpark. They're not going to vary tremendously. But then we've got some taxes. Florida is one of those states that charges some transfer taxes. And so the total of the closing costs is noticeably larger because of the higher title insurance expenses and those taxes. And let's move on to looking at Texas. So same lender fees, again, those don't change by state. With one small exception, and that's Texas. A little less expensive appraisal than Oregon, more expensive than Colorado and Florida. And there is an additional attorney review fee in Texas. Texas has some interesting legalities around mortgages, and so there is a little extra cost for navigating those things on the lending side. And the settlement charges are going to be the least expensive for the facilitating of the transaction. Again, that's that settlement service handling the money and paperwork for you. The title insurance, on the other hand, is much more expensive. And again, Texas is a state where unless you negotiate with your seller to pick up the tab for some of what would traditionally be the expenses for a buyer to bear for title insurance, you're going to be paying both the owner and the lender's policies, and they're more expensive, and there are some endorsements. And this is another state where a survey is pretty typical as a part of that title company's research before they issue the title insurance policy. Recording fees are going to be right in that same zone. And then there is a little small tax. These change a little bit by municipality, so I assumed a property in Austin, Texas for these numbers, and that small tax plus all the other things tallies up to about $7,000. So again, more expensive kind of, I guess, middle of the road, I suppose, between Oregon and Florida. So comparing prepaids, we can do this pretty quickly because, well, the interest is going to be the same. These are all the same sales price, same down payment assumed, so of course the interest is going to be the same. That won't vary by state. Homeowners insurance, you will notice, varies a good bit from one state to another. Different states have different risks for homeowners insurance. You can find hail in certain states that could damage the roof. Severe storms in other states, that would be a place where Texas and Florida are notable. And so you'll see, particularly in Florida, much higher homeowners insurance costs for you to insure your property. And you'll negotiate that or research that with your insurance agent of choice. But the property or the homeowner's insurance will be more costly in other states. Oregon's kind of lower end of the spectrum. But you'll notice that there's actually a credit when we start talking about property taxes. And that's because Colorado, Florida, and Texas have something in common, which is that property taxes are paid in arrears at the end of the year, and the fiscal year and calendar year for taxes match. So late in the year, the taxes come due for the current year. If you move into the property midway through the year, that means you'll be paying property taxes for part of the time the seller lived in the property, and so the prorate is going to go from the seller to you. And because I assumed an early May closing, I've assumed about a 4-month credit for January, February, March, and April paid to you by the seller in this example. That does vary, day by day. And then the escrow is going to be a reflection of how much those assumptions for taxes and insurance are. And property taxes are notably less expensive in Colorado for these numbers, and this would be a pretty close guess. I assume $3,300 for the property taxes for this $500,000 house. But in Texas and Florida, you can really expect a number that's going to be between $9,000 and $10,000 for property taxes. And so the tax prorates and the reserve deposit for taxes will both reflect that higher number. So if we tally everything up, for the prepaids, we're at about $5,700 for Colorado, we're at about $11,000 for Florida, and $8,600 for Texas. If we tally the grand total up, you're looking at about $13,000 for Oregon, about $9,000 for Colorado, $20,000 in Florida, and $16,000 in Texas. Now you're a closing cost expert. I hope you found this video helpful. If so, please like and subscribe, and reach out if you have any questions about your own home buying journey. My contact information is in the description below, and I'd love to chat.